Good afternoon, everyone. Thanks for tuning in to Wook Capital Management's Playboy, PLBY Group first quarter 23 earnings discussion. We're going to have the call broadcast in 10 or so minutes here. Let me bring JP up. Before I get started, though, I'm going to just get a disclaimer out of the way so none of you lovely gentlemen or ladies sue us. Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss, as anyone invested in Playboy knows. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So we got a very brief press release from the company. I didn't see if the 10Q was out just yet. Nope, not looking like it. So I'll briefly recap the 10Q, not, excuse me, the, I guess, PR updates, and then we'll, have a few minutes before the call starts. So, looking at the PR, which I'm sure all of you have already glanced at, I'll just kind of look at the headlines. So they note that GMV for the Playboy creator platform grew 2.4x times Q4. That's kind of a meaningless statistic since we don't even know what Q4 levels were. But we did get an updated data point from them, which is that their creator platform has maintained a weekly GMV CAGR north of 10% since the beginning of the year, with GMV up 2.4x in Q1. Okay, great. So the last data point we got was that since the relaunch, they had been growing at a 9% weekly CAGR when the relaunch was, I believe, in September. So that was in March, mid-March. So the rate does appear to have accelerated somewhat for the creator platform, which, in line with Ben's quote from the PR, that they are fully exiting their consumer products businesses to focus all efforts on the creator platform and licensing business. It remains, to be seen how well this creator platform will continue to grow. I'm still personally unsure that I believe the numbers that Ben Cohn shares, because I don't trust the man whatsoever. But presumably he wouldn't publish those numbers that are complete and utter lies. So, it's good to see that it appears to be an acceleration in actually the growth rate for the creator platform in the last couple of months here. We'll get, I'm sure, more details on what the current GMV run rate looks like, as well as any, I guess, new news on that front during the call. A lot of capital structure update, even though we don't have a balance sheet from the press release because Ben and co are clowns and put out pretty shoddy information for investors. We do know that from what they've disclosed in the PR, they have successfully restructured their outstanding senior debt. They eliminated the preferred stock at a discount. They did have to draw down some cash to do that, but the total outstanding debt number doesn't look like it's as much lower as it would have been because the preferreds are now into that secured debt.
Hey,
But it is
Uber,
nice that it.
Uber, the 10Q is out now. I tagged you.
Okay. I'm not seeing it on their page. Let
I
me
tagged
find
you
the
on
full
GMEDD.
text. Thank you. Okay. Where was I? So, yeah, they did another amendment of the senior debt facility. So they pushed out the leverage covenants from 2Q24 until 2Q25. Sorry, 1Q25. So another debt restructuring. It's good to see the amendments pushed out, or not the amendments, the covenants pushed out. That obviously buys them more room to shop the businesses that they are now formally selling. I had noted, of course, to several people that I was under the impression they were going to sell Lovers and Honey Birdette. They've now told the market that as well, and they
Rod,
have hired.
sorry. I mean, thanks for hosting this. Thank you is out. And they didn't finalize the preferred buyback during the quarter. So thank you doesn't reflect the mandatory, like the preferred shares. Their cash balance was down to 24 million. So they say that they withdrew 10 million from the banks. So they're back up to 34 million, I guess. So just a quick note on the thank you because I went through it pretty quickly.
Okay. They did note they incurred 1.3 million in costs associated with the formation of the Playboy China joint venture. So that's the formal confirmation. Mr. DCC, who's a speaker, had shared just the other day a nice LinkedIn screenshot showing that there was a Li and Feng employee working on the Playboy account, which kind of confirmed that they had closed on it. So now we get formal confirmation from the company that they've closed on the Playboy China joint venture, which again is more of a, I think, longer term. If how I would think about it, again, we can talk and debate and discuss more because obviously the call starts in about 5 minutes. But I think about it as, from what we heard from management last quarter, they have the global agent that takes a 20% cut off the top for the global licensing deals. By shifting to joint venture approaches in their major markets like China, for example, you can eventually in 2028, by 2028, put everything under the JV umbrella and out from under the licensing agent umbrella. The joint venture partner, Li and Feng's Charactopia, has a 15% ownership stake in this joint venture and therefore has some more incentives to actually grow the business as opposed to just taking a cut of every dollar sold like the licensing agent. So some more ownership and better economics, right? The 15% ownership of the JV versus the 20% licensing take. So that's obviously a longer term story, but it is something I think that investors should consider in their analysis. So what else do we get? The actual sales results were pretty poor. I haven't yet gotten to the Honey Birdette section to see if they call that out specifically. I don't know if you guys saw that yet. I know they don't disclose the segment level detail like that, or at least they hadn't. I'm going to assume silence means no.
No, I was going through it. I haven't seen the Honey Birdette revenue numbers.
Okay.
But one thing I saw is like the people who were in the preferred, they seem to have gone into the senior debt
Right.
somehow. The Fortress.
Right. The preferreds were converted into senior secured basically at that
Yeah,
discount. I'm
yeah.
sure
That
we'll hear how Ben tries to spin that. I mean, I actually think it's favorable that
no,
it
me
was
too.
done.
Yeah, it's a big discount and it eliminates a lot of dilution.
Yep.
I mean, I don't know how they did it. And we need to read. I'm sure, like it looks too good to be true, but I'm sure there are some caveats into it. But we'll have to see. Yeah, Honeybird, like the revenue number is bad, and I hope that badness doesn't come from the Honeybird debt sales because that's the thing that'll bring the most value to pay back the debt.
So on May 10th, we amended and restated the credit agreement to reduce the interest rate applicable to our senior secured debt, eliminate our Series A preferred stock, obtain additional covenant relief that I noted earlier. Okay, that's in note 18.
Yeah.
Okay.
What?
So
Why would they do it? I
why
mean,
would
the
the preferred
fortress.
owners?
Yeah,
Oh, yeah.
that's the I mean,
So it does say in connection with the A and R. I'm not sure what A and R is an abbreviation for. The A and R credit agreement, the A and R term loan. So Fortress actually
amendment and
owns
restatement.
90% of the term loans now, of the term loan. Fortress provided that additional financing
Yeah,
of 11.8. I mean, the good news, right, just from a stepping back, is that the owners of the debt have now done what, 6 amendments in 18 months. So clearly they have no interest in forcing it into default, it seems, given how willing they've been to continue renegotiating the terms of the agreement. The fact that it's pushed out to 1Q25 is important, because they're not going to be negotiating with a gun under their head, trying
yeah.
to fire sale Honey Burdette and Lovers due to, the 2Q24 was the, I think, and Arta, correct me, because I don't know the ins and outs of it 100%, but if it had become current, if it had been within 12 months that those covenants were going to come due, then I think there would have been, some implications for them. But now that they pushed it out, obviously they've got 7 months to consummate some of those sales to get back into compliance with the debt covenants, or otherwise amend the agreement again.
I think when they amended and got this additional preferred converted into senior, I think they talked to the lenders about selling these businesses. I mean, they did it concurrently, I think.
Yeah.
I mean, it's kind of like a bridge facility, as I see it.
Okay.
Hopefully
All right.
they'll sell it. They'll sell it. I don't know what the amount will be, but hopefully 180, 200, 220 for Honey Burdette. I mean, if that was the number, the royalty business plus the centerfold is worth a lot more than the market cap.
Right. Yeah. I mean, it's
The thing,
still
yeah,
extraordinarily distressed.
yeah. The thing I like about it is they're simplifying it, right? Like they're getting all this Yandy lovers, all this bullshit out of the way, which didn't create much value anyway. Honeybeer debt is a good thing to sell to pay back the debt. And then we'll have a simple business with the Playboy licensing and the Centerfold gamble, And if these growth numbers, weekly growth numbers are actually true, the cash burn of that business is not a lot, and it will become cash flow positive pretty soon, next year probably.
One other bullet point I'm reading here in this this restructuring is that they do have the authority to make up to 15 million in buybacks under these terms. So to me, once you consummate the Honey Burdette sale, you should pile every dollar into buybacks
No,
that you
for
can
sure.
at these levels. So we'll see. Again, as far as I know, Honey Burdette's been on the market informally for over 2 months now, and they've of course formally now communicated that it's also on the market. So, JP, do you have the earnings call audio ready?
Yep. It's about to start.
PLBY Group
All right.
First Quarter
I'm gonna mute
2023
him.
Earnings Conference Call and Webcast. At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Ashley DeSimone with ICR. Thank you. You may begin.
Good afternoon, everyone, and welcome to PLBY Group's First Quarter 2023 Earnings Conference Call. I'm Ashley DeSimone from ICR. Hosting today's call are Ben Cohn, Chief Executive Officer, and Mark Crossman, Chief Financial Officer and Chief Operating Officer. The information discussed today is qualified in its entirety by the Form 8-K that has been filed by PLBY Group, Inc., which may be accessed on the SEC's website and PLBY Group's website. Today's call is also being webcast, and a replay will be posted to PLBY Group's Investor Relations website. Please note that statements made during this call, including financial projections or other statements that are not historical in nature, may constitute forward-looking statements. Such statements are made on the basis of PLBY Group's views and assumptions regarding future events and business performance at the time they're made, and we do not undertake any obligation to update these statements. Forward-looking statements are subject to risks which could cause PLBY Group's actual results to differ from its historical results and forecasts, including those risks set forth in PLBY Group's filings with the SEC, and you should refer to and carefully consider those for more information. This cautionary statement applies to all forward-looking statements made during this call. Do not place undue reliance on any forward-looking statements. During this call, PLBY Group will be referring to non-GAAP financial measures. These non-GAAP measures are not prepared in accordance with generally accepted accounting principles. A reconciliation of the non-GAAP financial measures to the most directly comparable GAAP measures is available in the earnings release PLBY Group filed with its Form 8-K today. I will now open the call to Ben Combs. Ben, please go ahead.
Thank you, Ashley, and good afternoon, everyone. Before we get started, I would like to introduce Mark Grossman, our new Chief Operating Officer and Chief Financial Officer, who joined us just about a month ago. Mark brings a wealth of operating experience, both in consumer products and the technology sectors, to the team. As you will hear in a few minutes, Mark is in the beginning stages of helping me rebuild our cost infrastructure and has already identified millions of dollars of cost reductions not previously identified that we will be going after in the coming months. With Mark now on the team, I have reorganized our management team. Mark will be taking over consumer products in addition to his CFO responsibilities, and I will be focusing on our creator platform and licensing.
I am pleased to report that in Q1, GMV on our creator platform increased 2.4 times over Q4. And since our last earnings call on March 16th, our weekly GMV as of last week has increased a further 70%. We have also made significant progress transitioning the business to a capital-light model.
This afternoon, I'm going to share updates in 3 key areas. First, I'm going to dive into more detail on the growth of our creator platform and why we're so excited about the momentum we're seeing. Second, I'll share an update on the work we've done to improve the long-term economics of our JV in China, as well as other updates on our licensing business. And third, I'll expand on the progress we've made streamlining our operating model and reducing both our operating expenses and our gross debt. Mark will then walk you through some updates on Lovers and Honey Birdette and provide you with more detailed financial information.
First, on our creator platform. As shared at the start, Q1 was up 2.4 times, and we have grown an additional 70% since our last earnings call.
Our weekly growth rate year to date has remained above 10%. So we're really excited about the growth in revenue that our creators continue to generate on the platform. As of last week, we now have approximately 2,200 monthly earning creators and approximately 1.9 million registered users, which means that our creator and fan bases are not only growing, but also individually spending and earning more than they were last quarter. And lastly, as we're scaling, we're seeing economies of scale with our cost structure, and we're continuing to renegotiate more favorable terms with our key vendors. For example, we just added a new payment processing partner that lowers our fees by approximately 50%. Since we last spoke, our product engineering and design teams have remained focused on continuously improving the creator and fan experiences. On the creator monetization side, we have significantly improved our onboarding flows to support creators in earning their first dollars more quickly. We've continued to iterate on our profile design to drive more creator-fan conversations and engagement, which leads to greater monetization. And we've rolled out the ability to offer bundled subscription offers, promotional discounts, and more. We've also been focused on ensuring a differentiated product experience from our competitors in the space. Playboy has a history of unprecedented ability to meet new stars, and our creator platform is no different. Creator discovery and promotion is an area we believe we can win in. Since we last spoke, we've introduced a centerfold of the day section, a new UI that enables searching by categories of creators, as well as interest tags that creators can label themselves with for further exposure. We hear from creators every day how proud they are to be on Playboy, and we're dedicated to helping them be discovered and make more money than they can make on other competitive platforms. Today, creators earn income on our platform in 4 key ways. Roughly 60% of creator revenue is generated via messaging, whereby fans engage with creators in ways they cannot on other platforms and purchase content that creators send them in direct messages. Roughly 15% is generated via monthly subscriptions, and another 15% is generated via content unlocked directly on the wall of a creator's profile. And lastly, roughly 10% is generated via tips. At this stage, we split GMV 80% to the creator and 20% to Playboy. In addition to the continuous work we're doing to improve creator monetization, we also intend to soon roll out value-added features and offerings that allow us to increase our percentage of those economics. You can imagine advanced features or special access, such as the ability for a fan to show up at the top of a creator's inbox, or exclusive access to extended Playboy photo shoots, archival Playmate galleries, or one of our iconic Playboy parties all over the world as perks that would become part of a Playboy membership proposition that sits on top of individual creator monetization. We are still in the early stages of developing this membership value proposition and its potential tiers, but our goal is to ensure that as we scale our platform, we can meaningfully expand its profitability with services that have more favorable economics to Playboy. I am very encouraged by the momentum to date with our creator platform and look forward to keeping you up to speed on our progress. Next, I am pleased to report that since we last spoke in March, we successfully negotiated amendments over a number of our licensing agreements as part of our recently formed China joint venture. The goal of these renegotiations was to both support our existing licensees, whose businesses were significantly impacted by the COVID shutdowns from last year, while also establishing new, more favorable foundation agreement terms to drive a more diversified and sustainable business within our China joint venture going forward. While the revised agreements call for lower minimum guarantees, in exchange, we have removed exclusivity clauses, added stronger audit controls and visibility to sales data, taken back product categories, significantly increased our royalty or percentage of sales, and are working on transferring the ownership of the partner's e-commerce stores to the Playboy China joint venture. One thing to note is that during the first quarter, we did not book any revenue related to one of these licensees, as we are in the process of negotiating a revised agreement. We have now signed an agreement with that partner and are now working on collecting those royalties. We have also made significant progress with Douyin, the TikTok of China, to establish a flagship e-commerce store that our Playboy China joint venture is expected to own. Douyin is now one of the largest e-commerce engines in China, and Playboy had previously been blocked on Douyin based on our legacy licensing model. Our JV with the Fun Group and a revised contract with our licensees solves this issue. Moving forward, to solve the Douyin issue, we anticipate that our licensing partners will sell through the Playboy China joint venture Douyin store, which will help us more effectively control the Playboy brand positioning, pricing, product design, and marketing, and collect cash while our licensing partners operate manufacturing, fulfillment, and product inventory. All of this is part of our larger strategy to diversify our revenue across partners and businesses in China, while having increased visibility into direct sales and more directly controlling the consumer-facing components of the brand. Last quarter, we set forth our intention to transform our U.S. Playboy D2C business to a licensing model. We have now signed a binding term sheet with a non-affiliated partner who brings a wealth of experience and proven track record of success in developing and executing effective e-commerce strategies and brand development. This partner was instrumental in launching several of Playboy's hugely popular collaborations with streetwear brands, including Fragment, Antisocial Social Club, and Revenge. Their passion for our brand and understanding of today's customers are unparalleled. This transition is underway with the deal expected to close by June 1st, and we are excited for the next chapter of the Playboy shop and its enormous potential for innovation, including the integration with our creator platform and community experiences that only Playboy can provide. Moving forward, our partner will take over all costs and operations of our shop, and we will receive 15% of net revenue. We remain optimistic about the continued demand for the Playboy brand and unlocking its power across new categories and territories around the world. Our new sexual wellness licensees surpassed $1 million in total sales since launching at our Lover stores and are now rolling out to third-party retailers. We signed an amendment in Q1 to accelerate growth in LATAM, UK, and Europe. In Q1, our team closed a total of 15 new licensing agreements, of which 13 were international, across fashion collaborations as well as new men's grooming and home decor categories. Lastly, I'm happy to report on the progress we've made transitioning the business to a capital-light model, reducing our operating expenses and reducing our gross debt. With the momentum we're experiencing with our creator platform and the high margin revenue we see from licensing, we have decided to fully exit serving as the operator of our consumer product businesses. This means that in addition to selling Yandy, which we previously reported, we will now be taking 3 additional steps. First, as we just mentioned, we recently signed a binding term sheet to license our Playboy D2C business. Second, we've engaged Sage Group to explore all strategic alternatives for Lovers. And third, we've engaged Moelis & Company to explore all strategic alternatives for Honey Birdette. Because of this decision to fully exit the operations of D2C and retail consumer products, we've recently eliminated $3 million of personnel costs. As we continue to execute the remaining steps, we anticipate meaningful additional cost savings. We expect this decision to be net neutral to profitable to Playboy, given that the additional cost savings are expected to more than offset any loss in contribution margin from these businesses. We also expect that our free cash flow should be higher as we won't have inventory or the CapEx related to store maintenance and openings. Lastly, I want to share some positive news on a debt restructure and refinancing we just completed. Specifically, we were able to negotiate the assignment of approximately $91 million of our senior debt from certain of our lenders to a primary lender at 87.25 cents on the dollar, resulting in a discount of approximately $12 million. We also negotiated the exchange of our preferred stock, which is held by one of our lenders, for additional principal of our senior debt at a $7 million discount to the current liquidation value. In order to accommodate the restructuring of our senior debt and preferred stock, we amended and restated our senior debt agreement with Fortress and our other lenders. The restated facility actually lowers our total cost of capital by lowering the interest rate, so that in total our cash interest costs remain substantially the same, while eliminating the accrual and payment in kind features of the preferred stock. Fortress has also made available to us the $12 million discount obtained from the other lenders as new cash on our balance sheet. In total, we will have $210 million of gross debt outstanding, down from our $216 before, inclusive of the preferred stock. But we now have an additional $12 million of cash on our balance sheet, bringing total cash to an excess of $35 million. The bulk of the restated facility has no amortization payments, thus saving the company over $2 million of cash during such period, and has no leverage covenants until Q1 2025. The restated facility had no fees associated with it and has no prepayment penalty. We can elect at our option to prepay it at any time. Our intention is to prepay for that facility as soon as we can. To the extent possible, we would like to use the proceeds from the asset divestitures we discussed, as well as the proceeds we hope to generate from selling our art collection, a process we have recently kicked off, to pay down debt. Before handing the call over to Mark, I want to conclude by saying how excited I am by the momentum of our creator platform and our singular focus on the Playboy brand. With that, I'll hand the call over to Mark.
Thank you, Ben, and hello, everyone. Since joining as CFO and COO, I've been working closely with Ben to rebuild our cost structure and fully move the company towards a capital-light model. As a part of this process, we are aggressively reducing costs not needed to support our 2 business lines moving forward, the creator platform and licensing. These 2 businesses have greater potential for growth, higher margins, and lower working capital requirements. Before I get into the financials, I want to share with you a few of the initiatives we're taking at both Lovers and Honey Birdette. At Lovers, our store traffic is down commensurate with the industry, and in the absence of deploying significant sums of money to marketing, we are focusing on lifting our margins and diversifying our product assortment to give us the flexibility to run promotions in line with our competitors. Regarding margins, we are leaning into our Playboy Pleasures line of sex toys, a licensed product. Playboy Pleasures just crossed $1 million in sales and carries roughly 25 points higher gross margins versus our average gross margin, and has only been in stores for a couple of months. We have a new Playboy Pleasures assortment landing in Q2 and are developing another special line for later this year. In the last month of the quarter, we saw an improvement in conversion and average transaction value. And starting in June, we plan to bring our promotional efforts in line with our competitors to accelerate our revenue growth. Turning to Honey Birdette, our sales were down year over year for three primary reasons. First, as we previously discussed, we did not run our March promotional event this year. Second, the particularly difficult macro environment in Australia. And third, switching our digital advertising agency, which impacted our online sales, or about half of our sales. While we can't impact the macro environment in Australia, we are planning on running our June sale 1 week earlier to capture Memorial Day weekend sales. In addition, we plan to ramp up our digital advertising spend in the back half of the quarter with our new agency, as they were able to get Meta to unblock our advertising and have seen our blended ROAS return to normal. By way of background, Meta had blocked our advertising in the first quarter because they deemed it to be sexually explicit material. As a result, our blended return on advertising spending dropped from 18 times to 13 times over the year. We're also making a couple of additional changes to the business. We're going to reduce our SKU count starting in the fourth quarter of this year. It will allow us to make smaller inventory buys per collection without sacrificing the depth of our size scale. The result should increase our inventory turnover and free up working capital without reducing the number of new collections we launch per year. We are also aggressively cutting our supply chain costs. We have found inefficiencies in all areas of our shipping and logistics. Given the strategic alternatives we're exploring, we're going to pause on opening new stores. We remain very excited about the brand's position in the market and its long-term growth potential. Turning to Q1 results, we finished the quarter with net revenues of $51.4 million. Our direct-to-consumer business was down $12.7 million, or 25%. I want to point out that revenues from our Yandy and Playboy.com businesses were down $4.9 million. However, Yandy was just sold after the end of the quarter, and we recently signed a binding LOI to license Playboy.com. Accordingly, after the second quarter, we won't recognize revenue from Yandy and will only recognize licensing income from Playboy.com, which will be reflected in our licensing segment. Revenues from the remainder of our direct-to-consumer segment were down $7.8 million. The majority of the decline was attributable to reduced traffic, both in-store and online. During the quarter, we were not as promotional and allocated fewer dollars to paid marketing in both our Lovers and Honey Birdette businesses. Furthermore, as we previously communicated, we chose to forego a sale in March at Honey Birdette as compared to a year ago. Not running the March sale at Honey Birdette alone resulted in a reduction of $2 million of sales in the quarter. From our vantage point, it is clear that economic conditions are weighing on our consumer both domestically and abroad, and sales and promotions are increasingly driving the purchase-making decision. Licensing revenue decreased by $5 million versus the prior year period. While there is no doubt weaker consumer demand experienced by our licensing partners in China and the U.S. was a challenge, the vast majority of the decline was attributable to the timing of $3 million of cash receipts from one of our largest licensees in China. We booked revenue from that licensee on a cash collected basis. However, as Ben mentioned, we recently agreed to a revised deal with that partner and expect to collect the past due cash this quarter. Revenue in our digital subscriptions and content segment was essentially flat. The growth we are seeing from our creator platform, 2.5 times in Q1 GMV versus Q4, is offsetting the secular declines in linear television. With the gains being made by our creator platform, we should anticipate seeing this segment growing on a consolidated basis in the near future. Adjusted EBITDA was a loss of $10.8 million. However, $1.7 million of the losses were attributable to Yandy, $2.6 million of the losses were attributable to Playboy.com, and $2.4 million of the losses were related to reserve against slow-moving honey birdette inventory. Excluding those items, adjusted EBITDA would have been a loss of $4.1 million, and if the China revenue had come in on time, adjusted EBITDA would have been close to break even. It is also worth noting that the cost cuts we made in March are largely not reflected in our first quarter adjusted EBITDA result, which for the quarter would have been approximately $2 million. This number is only for the actual cuts made in March and not those previously identified to be made in the future. Since March, we have cut approximately $3 million of additional annualized headcount, and after a continued review of the various business lines and operating processes, we have identified additional cost savings through reprioritizing our spend on critical technology and reconfiguring our supply chain economics. Our goal is to simplify our technology stack and cut our supply chain costs while doing so with a leaner organization. We believe we can reduce our expenses by another $7 million on a run rate basis after the transition costs will occur over the next couple of quarters. I want to reiterate that the cost savings related to technology, supply chain, and inventory will take a couple of quarters to show up in our P&L. While we are not providing revenue and EBITDA guidance at this time, we plan to resume issuing guidance after we have finished implementing our operational changes and made further progress on our transition to a capital-light business model. To be clear, the capital-light business model to which we are transitioning has the same capacity for EBITDA generation and better revenue growth prospects, albeit with relatively small capex and working capital needs. Before I open the line for questions, I want to reiterate that given the cash on the balance sheet post-debt restructuring and the changes we are making to the business, we have more than ample liquidity moving forward. With that, I'll ask the operator to please open the line for questions.
Thank you. Ladies and gentlemen, at this time, we'll be conducting a question and answer session. If you'd like to ask a question, you may press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star key. In the interest of time, if you could please limit yourself to one question and one follow-up, and then re-queue up for more questions if you have some. Our first question comes from the line of Jason Tilchen with Canaccord. Please proceed with your question.
Great. Thanks for taking the question. I guess on the creator platform, could you just maybe talk a little bit about how your revenue share compares to other platforms in the space, and if you see an opportunity to potentially give back a little more of the economics, at least as you're ramping the platform to attract more creators? Thanks.
Thanks, Jason. It's Ben Cohen. Our revenue percentage as a percentage of the GMV or the total creator revenue is exactly the same as the other major platforms out there. I actually look at it differently. I don't see any need to cut that percentage at all. As we said on the last earnings call, our goal was to get to 10,000 creators by year end. We've grown from 1,500 to 2,200. And if you actually ran the math on a daily basis, just assuming averages to the end of the year, you're only talking about 35 creators a day. What we actually see is, the creator sitting at the nucleus or the center of that universe. These core services that we provide today are that 20% bucket. So, tipping, messaging, and subscription. We actually see a second layer of services that would be value-added services that could leverage AI or other things that would actually allow us to charge more or increase our percentage of revenue. And then on top of all of that, long-term, we see a membership opportunity, which would even be a higher percentage of revenue. I want to be clear, though, in the short term, we are focused on one thing only, which is adding more creators and adding more users.
Great, thanks. That's really helpful. And just quick follow-up to that. Previously, when you had the Playboy.com e-commerce platform as part of the strategy, there was sort of an idea of having a flywheel effect where you would have the creators promoting some of the products. How can you, in this new licensing model, still sort of leverage the creators to create exclusive collections or to promote the existing merchandise?
Yeah, so long term, nothing has changed from that. It's a licensing model, but with a partner we've done a lot of work with in the past, as we mentioned, Antisocial Social, et cetera. And so that is part of our deal moving forward with them, which is leveraging our creators to become affiliates, as well as developing select or special merchandise based on various events. So, whether that be a Playboy Super Bowl party or something tied specifically to a creator, or apparel that would only be available to our members, that is all part of the deal we have negotiated with that partner.
Great, thank you.
Our next question comes from the line of Alex Furman with Craig-Hallum. Please proceed with your question.
Great. Thanks very much for taking my question. It sounds like the creator platform is scaling very nicely. What are some, you mentioned other geographies that you could potentially take that to, when might that start to happen, and any update you can give us on your plans for the platform as you think about next year? I know it sounds like you're focused primarily on getting creators. When will we start to see some more significant leverage on the bottom line there?
Thanks, Alex. I'm a little bit confused on the additional geographies. The platform is open to almost every geography. Obviously, China not being part of that, given the restrictions on social media and technology. But we have creators from all over the world for the most part on the platform today. When you actually look at sort of the geographic distribution of creators, about 67% of those, 68% of those come from North America. So that is our single largest. But we have creators from almost everywhere in the world. When we think about guidance that we've given, or what we said in the last earnings call, we've continued to exceed our internal budgets since we last spoke. And what we talked about was the creator platform being break even to cash flow positive for the year. We did mention in the call that we've reduced our payment processing. We've added a new payment processor, which reduces our fees by about 50%. Our fixed costs aren't changing that much. And so, when you look at the end of the year, and without getting into specifics, what you end the year with as you get to that break-even to cash flow positive number is obviously on a run rate basis much larger moving into next year. If you did annualize right now our weekly GMV, and you did assume zero growth going forward, and we're growing at north of a 10% weekly CAGR right now, that number would be in excess of $25 million, and that's up from the $15 million on our last earnings call.
Okay, that's really helpful, Ben. Yeah, I must have misheard you about the international component there. Thank you very much.
Yep.
Our next question comes from the line of Jim Duffy with Stifel. Please proceed with your question.
Well, good afternoon. Hi, Ben. Hi, Mark. Mark, nice to make your acquaintance. Ben, I'm going to send this one your way. It sounds like a lot of hard work realigning the business model. You gave some great detail on what changes, what's no longer part of the go-forward strategy. Let's just take a high-level view. Can I ask you to detail what's left? Simplistically, what's the team of businesses you'll have on the field at the end of it all? What's the game you think you can win? And if you execute to the game plan, what do equity investors win? Paint us a picture of a shiny trophy.
Sure. Well, let me just paint you a realistic picture of what will be left. What's left is Playboy, and we're leaning into that billion-dollar brand of Playboy. And specifically, our creator platform will be our hero product. The growth we're seeing with that warrants that, and licensing providing high margin cash flow to support that. That's what's left, and what we look at, from a organization is a much simpler organization. And in fact, when you look at sort of a working capital situation as well, you're almost in a negative working capital situation based on how the cash flows in that business work.
Okay. Mark, I wanted to ask on Honey Burdette. This was, at the time of acquisition, mid-high 30s EBITDA margin business with an eye towards, what you might be able to realize in strategic alternatives. Where are those margins now? And what do you think is realistic for margin structure for that business?
Yeah, pleasure to meet you, Jim. The margins right now, what we're seeing is they're a little bit below where they've been historically. And a lot of that has been, due to the macro environment in Australia and what I've outlined. But I think going forward, we can get back to those numbers. And I don't think, we can't control the macro environment. We can control our internal costs. And I think that's where you're going to see a lot of the upside, because everything I talked about in terms of SaaS changes and supply chain, and then ultimately getting into sourcing, all of that's coming at the, to the benefit of Honey Burdette.
Okay. Do I re-queue, or do you have time for another? We have time for another one from you. Okay, great. You mentioned the new payment processor lowers fees by 50%. What are the payment processing rates? Have you been able to get that to the single digits with this new payment processor?
We have. Yeah.
Okay.
So, historically, I think, and I won't speak to ours specifically, but I would say that, in general, when you sometimes are dealing with not safe for work content, you're 10% to 12%, and we've been able to reduce those fees, as we said, by approximately 50%. And so when you look, long term, that is a significant margin improvement long term. And there are things that we're doing to improve that even further, down the road through content moderation and bifurcating content potentially between safe for work and not safe for work.
Oh, so I'll leave it at that. Thank you.
Thanks, Jim.
Our next question comes from the line of George Kelly with Roth Capital Partners. Please proceed with your question.
Hey, everybody. Thanks for taking my questions. So first one, curious if you could talk about your expectations, and I may have missed this in your remarks, but your expectation for Honey Burdette revenue this year. I think it was just over $80 million last year. Just curious what kind of growth you're planning on this year.
Yeah, I think right now, given the transition we're making, we're not giving guidance. But as I said earlier in my comments, we are seeing a pretty tough macro environment, and particularly in Australia, where it's underperforming the U.S. by about 2 times. So I'd leave it at that until we start giving guidance again.
Okay. And then second question from me is, in your prepared remarks, you talked about the new Chinese deals and how they carry lower guarantees. So I was just wondering if you could quantify that at all. You've given those kind of 10-year outlooks before where you just add up all the guarantees. Is there any way you can sort of help, not over 10 years, of course, but just over the next couple of years, how much lower your guarantees are now?
Sure. So we have 3 major licensees historically that pretty much accounted for 100% of our China revenue. And what I would say is, I don't want to get into the specifics right now, George, because we're still with one of them discussing things. But what we are focused on is diversifying that revenue stream. And so the question is, how do you do that? So we've taken back product categories. We've taken back exclusivity on product categories. We've taken over the e-commerce stores, or in the process of transitioning those e-commerce stores. We've actually increased our percentage of sales in those contracts considerably. And so all of that is to build a more diversified China business. It was all part of our plan. And that also plays into Douyin, which has taken a massive share of the China's e-commerce market, where historically we have been banned or blocked on Douyin. We now are in the process of opening a flagship e-commerce store where it's our intention that our licensees will sell through us on that. And so, in the future, when we're done with negotiations, we can talk about what it looks like. But we've also signed multiple new licensing deals with new partners in China. and so I just don't have the total MGs in front of us moving forward. But our intention long term is to offset any declines with a much more diversified revenue base.
Okay, thanks.
As a reminder, it is star one to ask a question. No additional questions. I'd like to hand it back to Ben Cohn for closing remarks.
Appreciate everyone taking the time, and we look forward to speaking to you on our next earnings call. Thank you.
Ladies and gentlemen, this does conclude today's.
All right.
Thank you for your participation. You may disconnect your lines at this time, and have a wonderful day.
Oh, I hope that he has a wonderful day too. That's intended for the operator, not for Ben or Mark. So it's 5:38 here. The call just wrapped. Anyone that wants to come up and discuss, share their kind of takes on the call, please feel free to request to be a speaker. Whatever you want, positive, negative, neutral, you're welcome to chime in. We'll keep it open so long as we have a productive discussion going. While waiting for anybody to kind of do that, I'll, look at my notes and remark on some of the takeaways. So we got some detail for the first time on how they generate revenue, or how they are currently generating revenue on the creator platform. So the majority, 60% is coming through from messaging, and then the balance is a mix of 15% subscription fees, subscriber fees, 15% per post charges, and 10% via tipping. So 60% messaging, it's mostly just currently serving as a messaging app. We obviously got the data that it's up 70% from the March GMV of 15 million that they had shared. So around 25.5 is the current annualized GMV for the platform, assuming no growth through balance of year. So 10%, a little over 10% is what the weekly CAGR has been. I have a monthly model. I don't have it broken down to weekly, but if I model out just something like 20% monthly growth, and I then have it declining by 1% through year end. So we end the year with monthly growth at 13%. That would put them around 65 million GMV as they exit the year, which again is obviously less than their current growth rate, but just as one data point to consider. They mentioned that they took down their processing costs by 50%. I don't know what that really means, because the numbers that Ben shared doesn't make any sense. Last call, he noted that variable costs on the creator platform he implied, given last quarter, right? Let's go back to last quarter. He noted that they basically needed to get to 45 million GMV, to be at break even, which the fixed cost portion of that is about the 500K a month they discussed, so 6 million, which then their 20% take on that 45 is 9 million in revenue. So 9 million less 6 fixed cost leaves you 3 million variable cost, which was a mid-high single-digit % variable cost. So he alluded to in the Q&A that for these sorts of platforms, the processing fees are typically 10 to 12% for the X-rated platforms, which this one shouldn't have been at that level anyway, as far as I understand. But it's hard for me to understand what he's actually saying. The real cost reduction is compared to last quarter. Sorry, I have a bunch of different analysts texting me about this. They should just jump on the call. So we got that. We got a big jump in registered users. So they had called out 1.4 million last quarter, which I'm sure that a big portion of that was people who'd registered early on with the initial launch. But, given that it's up sequentially 500,000 registered users, I think that's favorable. The monthly earning creators is now at 2,200. So, and that's good. It looks like the creator take rate implied with that 25.5 million now is actually up a bit. So my thought was that the mix of creators, maybe they'd had, and I know someone noted in the GMEDD Discord that Lana Rhodes had come back. So if you have a couple big creators, that's pulling that average that each creator's taking up somewhat. But as they said, the things that'll really drive that business for the balance of year and out years is creator and user growth. So we'll keep paying close attention to that. And many thanks to the folks, any of you who are listening, who are the guys who are doing it, who've been diligently scraping the platform for data to really keep investors abreast. That crowdsourced research, I think, is fantastic. And that's the way to, I think, get alpha in the market, is to have a better understanding than others. So, all right, China JV, we got some more detail. Not a lot. I mean, not a lot of firm numbers to run with, but we got detail that they've done a bunch of amendments on their licensing agreements. They have, of course, a handful of big licensees in China. So the new structure of those agreements is lower minimum guarantees. There are no longer exclusivity clauses in those agreements. Certain product categories they'll presumably now have the ability to sell themselves through the JV. And it'll be an increased royalty percent of sales take that Playboy gets. So their baseline goes down, but the percent take goes up with better tracking. There was one licensee that they noted they had signed a deal after the quarter ended, so there was something like $3 million in cash from that licensee that came in after the quarter ended. And they'll be working with Douyin. I don't know China well. Anyone who does know China well, please enlighten us on Douyin e-commerce opportunity. So let me keep going. We got the binding term sheet for the owned and operated Playboy.com. So as I understood it, now Playboy.com, they had been running. They took it from 0 to 22, I think it was, million by full year 22. They we're losing money on it, though, like they were losing money on Yandy. So they have a signed term sheet for someone else who they've worked with in the past to basically take over operating the business, and they're going to take 15% of net revenue on that business now, as another licensing agreement. So again, no capital outlays now for working capital, for inventories, for product risk. They'll simply take a cut off of the net sales from that. We got the formal news that of course did come out in the PR that they're going to be selling the Lovers and Honey Birdette. We got some more detail on cost takeouts. So they noted that they took $3 million in personnel costs out as a result of exiting the D2C business, which I had shared I think it was last week. I'd spoken to a former employee who'd let me know his team was let go. So, of course, Ashley Kechter and his team, it seems, has been entirely axed, as they're no longer going to be operating consumer products businesses themselves. We got the debt, the $7 million discount on the preferred exchange. They basically said their cash interest costs will remain comparable now, net of the preferred exchange, but that they're, of course, not accruing or having to do payment in kind on those preferreds. Finally, the art collection sale process has kicked off. Just a little bit late, but better late than never. As those of you who followed know, I've done some digging on that. The last time when the company was public many years ago, I'm talking 15 plus years ago, they had noted they'd had the art collection appraised at, I believe it was around $20 million. So this was many years of inflation behind us. So with inflation, that already brings the collection value up toward 30 million. It's hard to know if any of that collection was sold when they were private. Surely some probably was. And it's also hard to know, right, what they can get in the market. But the fact that there's a sale process that's kicked off finally is good to hear. And I've not seen that art collection considered in many of the sell-side analysts' valuations, including Jefferies, who had come out with a report just earlier this last week, at the end of last week. So they were really wishy-washy about talking about Honey Burdette. Clearly, that business is deteriorating. They've attributed it to weak Australian macro. They didn't provide any guidance on the growth there. They didn't really provide any guidance on sales, or they also chalked up some of the pain there, if I heard correctly, to their advertising return on investment being down from 18 to 13 times due to Meta labeling them as sexually explicit. And they're, of course, pausing opening new stores. So they're going to sell the business. Why would you be opening new stores? So there's some CapEx that won't be spent that was probably penciled in for all of our models, those of us who have an explicit one. Direct to consumer, they mentioned it was down 25% year over year, but that's transitioning. Licensing revenues were down, but the majority of that was the timing issue with the licensee renegotiation I mentioned. So licensing pretty flattish otherwise. And then let me see. I think that's most of the things that I jotted down. They expect to close on that D2C business sale, whatever we want to call it, by June 1st. So this is definitely, to me, it feels like the bottom has probably been put in here. I mean, once Lovers and Honey Burdette are sold, especially Honey Burdette, once Honey Burdette is sold, that eliminates any insolvency concerns. Whether it's sold for 150 million, 175, 200, 225, who knows? Any amount that's north of 125, 150 million is going to allow them to meaningfully reduce that debt. And thinking about what the question from Mr. Duffy at Stifel, what's left? You're left with, again, a core licensing business that we talked about before we went through the recording, that over time the profitability of that business should actually rise as they eventually get out from under the global licensing agent 20% cut and into joint ventures for using China as an example, presumably. But that the EBIT margin for that business should eventually be probably pushing closer to 80%, 85%. You're probably going to get some margin expansion in that business in the back half of the decade. But of course, this is years out, so nobody really cares. But it does improve the terminal value of the licensing business. You got then the creator platform, which again, if you're at 25.5 today, and you need to get to presumably less than 45 if you've cut processing fees like you claim, maybe your break even is really not that far away. They could achieve break even by the third quarter. If they continue to grow at this sort of a rate, actually, sometime in the third quarter, they should get to an annualized run rate break even, which, that model is fantastic. If you think about the incremental EBITDA margin, once they are at scale, right, you have your fixed costs that we talked about. Those don't change as you scale. You have then let's call it maybe it's 5-6% or so, assuming some of the cost takeouts that they talk about are real, variable costs. So your incremental EBITDA margin is in the low 90s. On every incremental dollar of that 20% take, it's almost all going to the bottom line, or at least the segment bottom line, if you will, when before considering financing costs and taxes and depreciation. But that's a very attractive model. As some of you may know, I had last year been saying they should have closed it, and at that time, it would have, of course, saved them money. They've made a whole lot of mistakes over. Specifically, Ben has made countless mistakes. I mean, he should have been fired for cause a long time ago. Sadly, he hasn't been. And of course, he's too much of a pussy to resign. So we're stuck with him. But the good news is the creator platform is showing promise, again, assuming the numbers they're sharing are legitimate. And it will be a very, he noted, right, you pretty much have no working capital requirements for this business. He said, quote, almost in a negative working capital situation based on how the cash flows from these businesses work. When you're just talking about a technology platform that you're basically the connectivity layer that allows these men and women to talk to the creators on the platform through messaging, being the bulk of the revenues. And then they're licensing, right? You own the IP. You don't have to invest much CapEx. Obviously, they opt to spend money on SG&A like it's going out of style on their parties and the like. But that's an operational decision, not a model decision. So, the licensing model, which the minimums from the K, of course, were $346 million through 2031. So just those minimums, which of course are now going to be different because of these renegotiations. So the minimums are going to go down, right? But that doesn't necessarily mean that your actual licensing dollars will go down because it's just a different model, lower minimum, higher percent take on the sales. So something to consider. I didn't see anybody request to come up and speak yet, so I'm just still talking. But if anyone does want to, please don't hesitate to come up and chime in. I'm running out of stuff to talk about. There was an incremental $7 million that the new CFO / COO / now head of consumer products had identified or had called out. So, that they called out a lot of cost cuts in the first quarter. They noted, of course, that a lot of those cuts weren't reflected in the 1Q result because they were made in March. So we've got a lot of, look, if you look at the results themselves actually on their face look pretty bad. But, when you start to take a pro forma analysis to it and you really think about where they're at, the fact it doesn't seem like there will be a need for incremental, liquidity through any sort of capital action. It does seem to me like the bottom is in. And we'll see how that plays out from a share price perspective. And after hours, it looks like it's currently trading at, I see on TDA at $1.80, which I think it closed at, well, I'll probably would have closed at 186. So I'm seeing 182 on Google. So it's down a couple percent in after hours, which for those of you who've been invested in the stock for a couple of years, that's a welcome change from some of the brutal earnings calls we've had experienced in the past 2 years. So, yeah, they really didn't disclose much about Honey Birdette, and clearly they're shopping the business. I had mentioned I was under the impression the business would be sold, and they finally come out and said that. So, the business, they didn't give us enough detail to have a very informed take on where margins are. They had come down from when they bought them. Gross margins had come down from when they bought them. They'd given us detail on the four-wall EBITDA margins for the U.S. versus Australia being, I think, 38% and 34% respectively. So, it is a profitable model on that basis, though. Again, we don't have much detail. They're blaming Australia weakness, for why. They said Australia underperforming the U.S. by 2 times, which doesn't really tell us much. But I still think that business goes for around $200 million. They paid cash plus stock for it, and if they get $200 million for the sale of the business, that plus Lovers, which I think Lovers. And they'd also talked about that business having some challenges. They give us some detail on the Playboy designed sex toy line having higher margins and accruing some sales, but it's pretty immaterial to the big picture. Even if they got $10 million, they paid, I think it was $25 million, which was 5 times EBITDA for that business. So, I mean, even if EBITDA's down to 3.5 or $4 million last quarter, they had noted it was about the same as when they bought it. So let's call it 3.5, 4. And even if they could only get 3 or 4 times on it, you're still getting 10+ million. so if you add 200 plus 10 right there, that zeroes debt, and you're left with a pristine balance sheet that has no preferreds anymore, no debt, a licensing perpetuity business, and a creator platform, which obviously could be worth nothing still, and it could be worth a whole lot. If you can play around with a growth model, using those numbers, I'll go back to what I said earlier. If I take 20% monthly growth, I reduce the monthly growth rate by 1% through year end, and then in 24 I reduce the monthly growth rate, which is 13%, and I reduce by 0.5% through year end, which gets me to 7 by year end 24. For full year 24, I show them with operating profit at $11 million, and that doesn't include adjusting for the processing cost takeouts they talked about earlier. So that would get them to a full year GMV for 24 of 132 million, just using that as an example. Obviously, it could be far different from that. But it is nice to hear that the growth rate accelerated for the creator platform from what they shared, and that it does seem like the profitability of the platform is getting better on an incremental basis from where it was a few months ago. So it's top of the hour. No one has requested to speak, and I've been speaking for a while, and I think I'm about out of things to say. So I'll pause if anyone wants to chime in. If there's anything I didn't touch on that you think is material or that you would like to add, please feel free to request to speak. We'll bring you up. Otherwise, I'm going to shut this down shortly. Hey, Arda.
Rod, what is I'm also trying to model the weekly growth, and since the starting number is too big for the centerfold, I mean, if like I'm doing something similar to what you're doing, and for the next 52 weeks, if I grow by 5% and drop the growth by 0.1% every week, and end up with like a 1% growth starting in week 52, I get to next 52 weeks of like 65 million in GMV, which is a decent number. I mean, they'll be breaking. I mean, this is very conservative number, but if you, I think like if they can get to 150 million, let's say in year 3, even that 150 million is like a 15 million kind of a profit going forward, which would kind of change the equity value, going forward. But like,
Yeah, because you got to slap a pretty rich multiple on this sort of a business, because it's not going to require much capital to, and they obviously had some software costs that they had to pay up front, but on an ongoing basis, the fixed cost that they talked about last time was about $500K a month. So, I mean, $6 million fixed cost, and if you're at 150 GMV, that's 30 in revenue. You're talking about a business that should be worth hundreds of millions of dollars at that point already.
yeah, I mean, as you also highlighted, when they sell, I mean, they bought Honeybird, that's assuming the stock price that they issued at the time for 235 cash and 313 total, Hopefully they'll get at least half of it, which will be like 165, 175. and with lovers and the artwork, they should be able to clean out the kind of the debt. And then with the royalty business plus the centerfold being cash flow break even, they should be in a position to start buying back stock, So really, I agree with you. I mean, the bottom is kind of in. Also, I don't know who is left to sell, who's selling now.
Yeah, yeah. No, I agree, and I would say I don't have an issue actually with this sort of a business having some debt. It's not an issue to have some.
I
I
agree.
would prefer that they maintain a little bit of leverage, and I'd actually prefer that they do the buybacks. Maybe you bring debt down to 50 million. I haven't obviously, since I've been on this call, I haven't gone through and tried to pick around at what I think they could come out of the year at from a fully pro forma basis, but I'm very excited that we're going to share our PLBY DD research in short order here. That'll have hopefully a couple different swags on what we think a bear, bull, and base case could be from here, net of all this information. So I'm actually, it's on its face an ugly result, but I think if you peel away the amendments, the fact that they pushed out any solvency concern, which gives them the time to run these strategic alternatives for the lovers and Honey Birdette businesses, that they should be just fine. I mean, I know there's a lot of people in Australia, at least, that have a very good impression on the Honey Birdette business. So whether it'll be an Australian buyer or somebody else, I have no idea. But my understanding is that business shouldn't be that difficult to sell. Now, they're not going to get the 10 times EBITDA that they want. I think that's what management wants, and I don't think they're going to get it. I think they're probably going to get more like 6 to 8 than 10. 10 would be a quite bullish outcome, I think, at this point. They paid 12. Obviously, that was in mid 21, so it's a different environment, but it is still a pretty solid brand. It's definitely unfortunate to hear about the marketing constraints, though.
Maybe the original sellers will buy at a discount.
Yeah, that'd be a nice win. I don't know that Eloise is going to be interested in that, but you never know.
But at least they have Moelis involved. They're a serious company, so I'm sure they're trying their best.
Yes, and Moelis managed the sale of Honey Birdette to them, so they probably have familiarity with whoever was interested at the time, and they should know it fairly well. I see a question from the GMEDV chat. So the go forward strategy has been creator plus licensing. Do you believe that strategy stays in place if the creator platform misses targets? So look, I mean, if the creator platform growth all of a sudden sputters out and it's no longer on pace to achieve break even, then I think that they would probably go ahead and look to just sell everything. At that point, what's left is the licensing business. Again, that business should be worth several $100 million for the Playboy IP, the licensing contracts that they have in place, the contractual minimums, which you talked about being reduced. Yeah, maybe you need to change how you think about it a little bit, but it's still an attractive asset. I know I spoke to another investor that knows someone who manages this sort of a business, brand management, who had expressed a view in the past that he'd be willing to pay more than what the current enterprise value is for just the Playboy IP, for example. So it all gets back to the enterprise value is extraordinarily disconnected from the assets they have. And I think that the reality is, barring some implosion of the creator platform that leads to Cohn's firing, that just value will be realized in short order here upon consummation of the disposals of these non-core assets. And it's not going to get people back who participated in the SPAC back to break even. I don't think. In a base case, I don't think we get past $10. If the creator platform can really start to get going, I mean, again, the growth did accelerate. I think that it's likely that might have been just bringing back a couple headline people to the platform, like Lana Rhodes. So I don't know how much of that is one time versus sustainable. Clearly, they talked about improving their onboarding process for the creators, but I know that the guys who watch, as I mentioned earlier, who've been watching this very closely, had been reporting the active creator counts, been somewhat disappointing. So I had modeled out that they'd be at 2,300 active creators. They were at 2,200, so I was pretty close. And again, that's not just my information. That's thanks to the work of the other guys who've done this crowdsourced research. So, I think it's hard to argue that the creator platform is a zero today. It certainly looks like they will be able to achieve at least the scale necessary to be somewhat profitable. And, as Arda pointed out, if you don't have to be that aggressive on the growth assumptions to see the GMV quite rapidly push into the multiple hundreds of millions, by 25, 26. And then, if you're talking about, say, just 300 million GMV, you're talking about an operating profit in the mid 30 millions, which again, I think you would slap a low mid teens type EBIT multiple on that sort of a business, possibly more. I don't want to give them too much credit, though. The market certainly won't. But if you said 12 times 35, and then you discount that back a couple of years, that's again several hundred million. You're north of you're close to 300 million in value for that business if that growth were to pan out. Again, the entire enterprise value today would be pretty comparable with just the creator platform, which is why I keep saying I think that it's a sum of the parts play. And I think the market will wake up to it once some of those parts are disposed of.
Yeah.
But for now, the actual results still are ugly, and I don't think many people are actually doing the work on this. And it's too small for most institutions to care.
Yeah, one thing, if they sell Honeybird debt and start doing a buyback, I don't know what the price will be when they sell it, and what the stock price will be. But it's if they could just buy some stock back here, like 20 million shares or something around this level, it would be a
Well, it
huge
looks like
upside.
from the queue, they can only do 15 from the most recent amendment, was my understanding.
Yeah, that's still not bad.
Oh, no, sure. I mean, if you could do, 9 million shares at current levels and you go from 70, whatever they're at now, I didn't even look.
73 something.
73.6. So it's up to 73.6. So if you took that, yeah. I mean, if you could cut shares outstanding down by, more than 10% pretty easily. Look, the preferred exchange,
Very
I
positive.
think, again, that was a good move, positive move, yeah. While the headline debt figure doesn't look like it went down much, I think it's important to recognize that they took what would have cost them at face value 60 million to prepay, and that's now become part of the secured term loan, which again they've implied they will pay down using the proceeds from Honeybird debt. So. If anyone, Arda, just before you chime, if anyone else who's listening, I know there's several people who I respect their input on this company, and even if you aren't that well acquainted with it, if you wanted to ask a question, please don't hesitate to request to speak. Arda, go ahead, sorry.
Yeah, one thing, what do you think the equity price will be if they sell Honeybird debt for like 175? Will the stock price stay here?
I don't see how.
I wish it did,
doesn't
so
really
that they could
make
buy
sense.
back a lot of stock. It won't stay.
Right.
Yeah.
So the market cap is now what? The shares are at 180 after hours, with 73.6. So 130, I'll round it up to 133 in equity. The 210, right, in that now total debt. We don't have to worry about preferreds. And then I didn't hear if they said it explicitly or if they made an implied statement on cash.
35.
I think it was implied.
30.
Okay, it's 35.
Yeah, that's what he said. Over 35 million.
Okay. Yeah, so you're still just a hair over 300 million in enterprise value. I mean, if you sell Honey Birdette for 175 million, you're left then still with art collection, which I can't see them getting less than 10 million, 15 million for. Lovers, can't see them getting less than 10 million for. Let's call that 25. So now Honey Birdette and Lovers and art is 200. Right, so now enterprise value for the Playboy licensing and creator platform at this level is about $100 million, 105 million. I mean that's just irrational.
Plus you have the net operating loss carry forward.
Exactly, that they have a tax shield
Huge.
that'll protect if the creator platform scales.
Yeah.
That'll protect those. Yeah. So I've said this for months. I've been wrong on the stock. It's been the worst stock of my career. I know Mr. McGough's been at it longer than I have, so at least we both get to wear the egg on our faces. I've noted in my personal account my losses are in excess of $500,000. For Wook Capital Management, we haven't. Look, we were diluted. We've noted in the past that we'd been just shy of the reporting threshold. Of course, we were diluted as anyone who didn't participate in the subscription were. But we are still one of the largest external shareholders, and I think we look forward to putting out some research that I hope will paint the picture for people that I still think this is quite it's in my personal account. It's my largest position, and I took it up. I bought a lot of shares in the 160s. I have a Roth IRA that it was 100% cash, and I turned it to 100% PLBY with an average of like 166. So I think it's a compelling opportunity here. I actually don't see realistic downside risk, but for some real nasty, global tail cases where if there's some nasty stuff that happens where they're unable to sell any of these assets, or they have to. Look, they are going to be on a timer. Again, I'm happy they extended the timer now. We know they've really got all of the second half of this year to get the sale done of any and all of these assets they've put on the market. So, barring some World War III, I think we're going to be okay.
One thing. I mean, how many shares I have. 80% of the shares I have is borrowed in Interactive Brokers.
Oh yeah.
I mean, there are a lot of shorts. I don't know how much, but like 80% of my shares are borrowed.
Yeah, and that's a good point. For whatever reason, I think it's more basket rather than idiosyncratic selection of the security. I think it's more that it's a de-SPAC, therefore it gets shorted by algorithmic. We're going to short this basket of stocks. But you're right, and I've seen other people call that out, that there's a lot of lending going on for anyone who has their shares at IBKR. And what is the rate
4%,
that you're getting?
I think. I mean, I get 2% because the rate is 4%. I think.
Okay. Yeah. So if we get, look, the short interest isn't extraordinarily high, but it's I think it's like 7 million-ish shares outstanding are short as of last data from FINRA. So if there were some short covering, sure, that becomes a marginal buyer. But Arta, it goes back to what you said, Arta. Who is the marginal seller at $1.80, other than some incremental short sellers, or maybe some retail folks who are fed up with it, which I could fully understand. I just think that selling here is like capitulating near the lows. Now that we know, that the creator platform is doing better than what we thought 2 months ago. And it looks like it has a real pathway to getting the scale necessary to being a meaningful value contributor, and that they have formally put Honey Birdette on the block. That wasn't something they'd formally done. They said they'd hired a banker for growth capital. I know from conversations behind the scenes that I think that anyone who'd approached them interested was being made aware that the business was for sale. But now they've told the market publicly, it should bring some more eyeballs to it. And look, not Honey Birdette, Victoria's Secret bought Adore Me. I tried to do some analysis on Adore Me's, gross margin to enterprise value, like I came up with 190 million. Now Adore Me is a slightly different business model, but just kind of trying to do like for like with the the EV to GM. Like I came up with 190. So I think Honey Burdette they're going to get at least 150 in a bear case, and I'd expect closer to 200 in a base case still. So we'll see. I don't see any more questions in the GMEDD chat. Again, don't see anyone else requesting to be speaker. I'm going to be hosting under my personal account, which I do have in the room, at Rod Alsman. We host a weekly open mic at 7 o'clock on Wednesday nights. So I am going to shut this down by 6:30 either way, so I can get a bite to eat and do the things that humans do. But I would love to field any other questions or thoughts. A lot. I know you're down there listening in. If you want any thoughts, but yeah, overall, they're not going to be on bankrupt. I think that risk is pretty tail at this point. What's up, Chris?
Hi, Rod. I know you guys have been discussing the Centerfold platform, the creator platform. But I remember earlier you were saying, like a few weeks ago, you were saying that like by mid-year there would be an update on whether they can break even or not. After this call, do you feel like there's a little bit more uncertainty? There's a little bit more certainty with regard to that, or do you think it's still kind of up in the air?
Yeah, I think it's more likely that they continue operating it unless something meaningfully changes the current trajectory. I mean, there was an acceleration in the growth rate, and it's hard. That's a good thing to see when you're scaling, a software platform business.
Yeah.
Because if the growth had been decelerating, which I'm not sure how much of it's from mix of creators, like bringing back some of the more heavy hitters, and whether that's a sustainable lever that they can keep pulling. But it was good to know though that most of it's really just messaging, and
yeah. Yeah. Yeah, it's good to know, I guess, because it's hard to know really, because they give like week over week, like compounded growth, but like what's their baseline for that? Like, is it very clear? Like, I mean, it seems like they're kind of afraid to give like nominal figures.
Yeah, they gave us creator, right, 2,200. They gave us user 1.9 million. So we can compare that with what they provided last time and see the growth.
Also, they gave us their run rate is 25 million. If you divide it by 52, it's like 500,000 a week they do now. So.
Okay.
Yeah, but compounding works like fantastically, right? I mean, if they continue, like they cannot grow 10% weekly for another 10 weeks. If they did their on the 10th week, their revenue would be like 1.1 million weekly, 1.2 million. So it will come down. I mean, if they grow 10% weekly for the next and declining by 0.1% every week, they will do 340 million in the next 52 weeks, which is impossible. So that number is going to come down significantly. But even if you do 5%, declining like from 5% to 4.9 to 4.8 to 4.7 and going down all the way to zero almost, like they'll do 64 million in the next 52 weeks. So, which is kind of a break even, not even a break even. I mean, they'll make a little bit of money there. So for me, centerfold businesses, if things don't change significantly, it's kind of already in a break-even trajectory. And Rod is doing, as he said, this model. Hopefully, he'll share it with us. But my kind of a base case scenario would be they would be at a run rate of 150 million, like in 2025. I would be surprised if they didn't do like 120 to 140 million. So in that case, the business will be giving like 15 million in EBITDA, which is like not bad.
And
So
this is
one other thing I wanted to say,
yeah.
just for those listening who are shareholders, is that you have until June 14th to vote. Now, look, your vote isn't going to change the outcome directly, of course, but I would encourage shareholders to voice their frustration through the proxy vote. If you're dissatisfied with management, vote no. And that's what I'm doing in my personal account, and what I'm going to advise to our investment committee, that we vote our shares as such. Obviously, let me disclaim any beneficial ownership beyond my own shares when I say that, but that I think is another way that investors can send a message to management of their dissatisfaction with Cohn and Co. It's really just the two director nominees and the compensation and the accounting firm. So it's not really anything meaningful. It's a non-binding advisory vote, and given how many shares Rizvi and Cohn own, it's unlikely to achieve the level necessary. But one thing that is also true, and I'm sure they're aware of, is that Cohn and Rizvi are both up for re-election next year. So assuming that they're still public by then, they certainly will have hoped to have gotten their ship righted, lest they have to face a contested proxy, which could be interesting, but is obviously a long shot if anyone were to go that route, given the consolidated insider ownership. But I'm going to vote my shares tonight, actually.
Yeah, I think I'm going to make another hot chocolate.
Okay, so I mean, look, it certainly looks like the creator platform is growing healthily and on track to get to break even some point in the back half of this year, or at least break even run rate. We'll keep watching it and keep sharing what we're seeing on both Twitter and Discord. And as I mentioned, we are putting the finishing touches on our PLBY DD report that we're eager to publish. And now that we have the quarterly results, I've just got to get some things updated, and hopefully we will be happy to share that soon publicly. So I'm not seeing anyone else request to come up. I will, Arda, Chris, if you guys had any last words before I wrap.
Thanks a lot, Rod. I mean, it was like we're talking, I don't know, for the last 6 quarters maybe. This is probably like I think I share your view. I mean, I think we're close to the bottom. Similar to you, I'm also in a big loss in my personal account, but I've added a lot at these levels, like 165 to 180, and I'm looking at some of the part. Like, last thing to say, I gotten this name because of Hedgeye. Because I like the guys. Some of them are my friends, etc. As the only growth play in my portfolio at the time, I'm a value investor. But now it has become one of my core strategic holdings, because it's a deep value investment right now. So I'm happy, at least, that Playboy is no more non-core position for me. It's a core position because it's my strategy.
Yeah, I think from our talks, and anyone who knows me, who's followed me over the years, knows I'm more of a value-oriented investor too. So this didn't fit my typical investment themes. I had always kind of leaned on the fact that unlike most companies that pursued a SPAC or IPO'd, specifically the D-SPAC, this one actually had a solid core contractual business that was highly profitable. So that was always kind of the underlying reason I felt that bankruptcy risk wasn't really a thing. Unfortunately, clearly didn't do enough due diligence on the operator at the top, who's just been an absolute piece of shit, horrific operator. Everything he's touched has burnt, and frankly, his narcissistic personality disorder is just very sad. It's just been very destructive for many people. But on the bright side, again, the math is the math. Assuming that they continue on this trajectory, they're able to successfully sell off these non-core assets. It's just really hard to argue with the value proposition. You call it deep value, and I would tend to agree. And I think a big issue remains it's so small that there's a few issues. There's the size issue that institutional money isn't that interested in at this size. There's the insider ownership kind of control issue because of RISV's control. There's a control discount actually right now on the bundle of assets, and there's also just the gap financials. While they're going through all this restructuring, they took the impairments that we've talked about that they took in the third quarter of last year, which were of course non-cash, but you see huge headline losses. I think that just most people haven't really dug into the sum of the parts situation, and sum of the parts is a stupid analysis unless they're pursuing disposal of the parts. And it's very clear to me, it's been very clear to me, and it should be more clear to the market now, given they've more formally conveyed that, yes, we are selling off all of the parts, but for the core profitable licensing business and the growth call option. So it's going to be a fun ride to see where it goes over the next few months as we get into the back half of the year. If Centerfold, the creator platform's growth can continue. If it does, great. If it doesn't, they may change their options. I'm gonna try to lay that out in a bear case of what I think might happen. I still don't really see a bear case outcome below the rights offering price. I would be hard pressed to see a take private transaction by RISV or a tender offer by someone that were for less than $2.56 per share. So that's kind of my bear case. Whether that works out or or we get a better outcome, who knows? But when you see a bear case that's what's that, 40% higher than the current price, that's pretty compelling. And I've obviously been closely following the name for a few years now, and I know a lot of the investors. I've had the pleasure to speak with management over the past few months, so that's all helped inform my view. But if Ben Cohen resigned, the stock would likely rocket, and I think that's a big issue here. That I know many investors who refuse to buy the stock because of him being the CEO still, and I do think it will be to their detriment if they opt not to, and that was the only reason they were refusing to. But I can understand it, and it does not look like he will unfortunately pay the price. If the creator platform keeps growing like this, it looks like he will manage to snake his way through, but we'll see. It's 6:30 though. I'm going to wrap things and leave it there. We will be back next time, next quarter, whenever that is, in August, probably early August, with the next quarterly Playboy earnings result. Again, just to kind of recap, Wook Capital Management, our big part of our thesis is that crowdsourced research can allow retail investors to achieve investment alpha. And this is, I think, a stock that's a great example of a lot of information being able to be dug up and identified that is being missed on the surface level. So we'll see how it turns out. But we started this at 4:45. The entire call is available on the replay. We played through from 5 to 5:38 when the call wrapped, and then we had about an hour of discussion after the call. So if you missed it, the replay will be available on Twitter. And we'll also be back with our regularly scheduled Wook in Review Friday at the close. And for those of you who are not sick and tired of hearing my voice yet, I'm going to be hosting a market open mic spaces from about 7 to 9 o'clock tonight. So in about a half hour, we'll kick things off under my personal account. So thank you so much for everybody for tuning in. Really enjoyed the space. Hope you found the information valuable, and look forward to sharing our research with you all soon. And we will talk. We'll talk soon. So stay safe out there, everyone. Cheers.